Hello, Ed Yardeni here. I hope you all had a great Easter and Passover and enjoyed the weekend. If you don't happen to celebrate any holidays, at least it always seems like the sun is shining and it's very pleasant on Easter and Passover. So I hope you had a good time. We took Sunday off. Our staff needed to celebrate the holiday with their family and friends. So some of you noticed that the morning briefing didn't come out this morning, but it will. The advanced copy will come out on in the afternoon, so you can look forward to that. And I will in this chat go over the charts that will be displayed in the morning briefing for Tuesday morning. Lots to talk about, as there always seems to be. I mean, you got to say it's never a dull moment in our business. So right now, I think clearly the focus is on the Fed. Fed officials are going to be in their chatting mood right now. Following FOMC meetings and before FOMC meetings, they have kind of a wide range of opportunities to present their views. And it seems like they're all pretty much on the same page. There are no doves anymore. They are all hawks now. Even Lael Brainard, Fed Governor Lael Brainard, gave a speech recently in which she squawked just like a hawk, like the rest of them. And I think the message is coming through very clearly that while they remain data dependent based on what they know today, I think they've come to the conclusion that they are way behind the inflation curve and they have to do some quick catching up. And they seem to be signaling that they're in a little bit of a panic to catch up. And they're talking about now 50 basis points at the upcoming meeting in May, and then possibly 50 basis points at the meeting after that, and 50 after that. And some of them are indicating that maybe the new rate hike interval is not 25 basis points, but at 50 basis points for as far as the eye can see. And they do seem to also be signaling that they want to get to neutral on the Fed funds rate very quickly. I'm not a big fan of this concept of neutral. I don't know how you measure it. I guess they have their econometric models, but they seem to believe that neutral is 2.5%. Now, James Bullard over at St. Louis Fed is the uber hawk at the FOMC, and he said, well, getting back to neutral just kind of gets you to a rate where you're not really bringing inflation down, you're just not accommodating and bringing inflation up. So he's indicated that he'd like to be even more aggressive. But I think the consensus on the FOMC right now is let's do 50 basis points per meeting. If we can get away with it, if the data continues to show that we need to do it, let's do it for the next 5 meetings, which will get us to 2.5 to 2.7%, 2.75% by November. And then if we have to go a little bit higher, let's go to 3%. And then let's just wait. Let's see how the economy responds to all that. And so let's get going and have a distinct idea of where we want to go, convey that to the markets. And I think they've done that reasonably well. And the markets all in all, the stock market all in all has actually held up remarkably well so far. The bond market, on the other hand, is finally behaving the way that I thought it would start to behave last year, as I mentioned before. And it's gotten to 2.5%, and now we're at 2.8%. And I think we are going to see 3%. And I think we may see a bit of a kind of a blow off in the yield here. I think we'll get to 3, maybe a little bit above that. And then I and everybody else will start to talk about 3.5 to 4%. And wouldn't you know it, that'll turn out to be at least a pause in the rate hikes. 3% seems like a pretty good level to hit and kind of stay at for a while. And I'm kind of more inclined to do that. I know a lot of people are going to be looking at the bond yield charts as they are right now and saying that we're breaking out of this long-term bull market. Yields are finally rising above that channel, downward channel that started in the early 1980s. And here we go. We're going to have a huge bear market in bonds. Look, it's clearly a bear market in bonds, but I think it could just go sideways for a while. So I don't think necessarily that we're going to go to 3.5%, 4% once we hit 3%. So we'll see how that all plays out. A key variable here in terms of the Fed's data dependence is going to be inflation. They have given that a much greater priority now than the labor market. The labor market's doing absolutely fine. It's tight as can be, and there's lots of articles around indicating that there's a lot of people that aren't coming back to the labor market, and that one of the issues with the labor market's tightness is a lack of immigration into the country. Kind of hard to believe that story given what's going on in the southern borders, but then again, the folks who are coming in from the southern borders aren't necessarily going to be joining the labor market anytime soon. So let's take a look at some of the charts here with regards to where we are in inflation, consider our forecasts. Let me share my screen here with you. There we are. Okay, so again, today's April 18th, and this chart book is for the morning briefing tomorrow. But as you know, we send out in advance just to give you some opportunity to read it in your leisure time in the evenings. So figure one is looking at the federal funds rate versus the headline CPI inflation rate. Now, Fed Chair Jerome Powell has said a few times that even though this chart clearly shows that if you want to bring inflation down, you can always do that by engineering a recession. He and other Fed officials are thinking that they can engineer a soft landing this time. And to indicate that that's happened before, they pointed out, Powell pointed out that look at this red line, that's the Fed funds rate. He said, look, we raised the Fed funds rate here in the mid 60s. And then we were able to bring it down because look at inflation. It moderated. Didn't last very long because then you had this big upsurge in inflation. This was the guns and butter environment of Vietnam. And so inflation continued to surge, and so did the federal funds rate, and then you caused a recession. But that's certainly a scenario back here where, at least for a short period of time, they were able to tighten the Fed funds rate and moderate the inflation rate without a recession. Then Powell pointed out that they did the same kind of situation, I guess, here in the mid 1980s. So again, you're looking at the Fed funds rate going up and then coming back down as inflation continued to moderate. Some of that had to do with the success of the Reagan administration in convincing the Saudis to produce a lot more oil to break the back of the Soviet Union. But nevertheless, it didn't take long before inflation started to accelerate. And then the Fed was raising the interest rate again, the Fed funds rate again. And this time we did have a recession. Then Powell went to the mid 1990s and said, look, we did it kind of again. We kind of tightened here, then we stopped tightening, lowered rates a little bit, inflation moderated, but then it did pick up. So, I mean, it's conceivable and it's plausible that they could do that again, but history shows that it only lasts for a year or two before inflation picks right back up and the Fed has to raise rates to levels that cause a recession. Because one thing for sure is recessions do cause inflation to come down. So what is the market thinking? Well, the market is listening to the Fed, and the Fed has pivoted from being mostly concerned about the unemployment situation to now being very concerned about inflation, and in various speeches, Fed officials stressing that inflation is too high and they have to bring it down. So they have to act more aggressively, not just in raising the Fed funds rate, but also in letting the balance sheet run off at the rate of $95 billion per month. And that's quite a pivot because until recently, the Fed was buying $120 billion per month in treasuries and mortgage-backed securities. Now they're talking about going the other way and actually letting $95 billion run off. If it was up to me, I would tell them, hold off, just do the 50 basis points increases over the next 5 meetings if you can, if the data will let you do it. I think the inflation will let them do it easily. But hold off on running off the balance sheet, because we don't know how that actually plays out in the bond market, and the extent that that creates more tightening than they intended. But they're going to go ahead with it, and we have to factor that into thinking about the second half of the year. But the a 2-year note, which I think is a pretty good 1-year forward indicator of where the Fed funds rate is going, is telling us that over the next year we're going to 2.5%. So I guess it's factoring in that somewhere along the way here, that may be about as much as we can handle. And it has overshot, so maybe it'll be it'll overshoot. I mean, just imagine 50 basis point stepwise function here, the way we had this kind of tightening back here. So again, history shows back to 1921 that for sure, if you want to bring inflation down, just trigger a recession. And since the 1960s, there's only been 3 episodes, fairly short episodes, where they were able to bring inflation down with a soft landing. I guess since I had a happy childhood and I tend to be an optimist, I'm kind of rooting for them and saying that they might get it right. I still think that some of the inflation is pandemic related. Some of it is related to consumer durable goods inflation, which I still think is going to start moderating. We've seen a first sign of the potential for used car price inflation to be starting to come down. So I'm looking for more of that kind of news and consumer durables up ahead here. But our number for the headline is right now we're at 6.4% on the February reading. We think it's going to peak in this 6 to 7% range. Then thinking it's going to moderate down to 4 to 5%, and then next year 3 to 4%. I kind of doubt we're going to see 2% in the next few years. The Fed officials are still talking as though they could get to neutral, maybe overshoot a little bit on the neutral Fed funds rate and get inflation back down to 2%. But I don't think that's going to happen, because I think the offset to whatever improvement we get in consumer durable goods inflation, I think that'll be offset by rent inflation, which I've discussed with you before. Fed Governor Waller just gave a speech on the red hot housing market about a week ago, and he acknowledged that we could see the rate of rent inflation in the CPI double in the next year or so. And that's because leases today, new leases are going for 12 to 15%. Again, in his speech, he pointed that out. And it takes about 12 to 24 months for the pickup in inflation and new leases to get into the entire pool of leases. And that's when it really shows up increasingly in the CPI inflation rate. So I think this is admittedly an optimistic scenario. Over the weekend, I've become increasingly concerned about the pandemic in China. It looks like it's kind of out of control, and they're trying to control it in ways that are shutting down some of their factories. On the other hand, a lot of people are sleeping in their factories so that they continue to manufacture. So I wouldn't completely come to the conclusion that China's the parts we need to make things and the goods we need to that we consume, those will suddenly not be available. But it is a concern, and clearly the supply chain disruption issue is just not going to go away for a while longer. So this is my forecast now, but subject to change. And if it's changed, it's not going to be lower. It's going to be a higher for longer inflation, which is kind of admittedly what I've been doing here for the past year. But I don't think I've been the only one coming to that conclusion. I think I've been a little bit ahead of the Fed, but anyways, let's move on here. So what's the latest inflation news? It's not, there's no signs of a peak, quite honestly. You know that, we all know that. Let's start out with commodity prices. Commodity prices, all-time record high for the all commodities index. That's the blue line here, and the raw industrials is all-time record high, which is really quite amazing when you consider that the global economy isn't looking all that good. The global economy is slowing down. I know China's real GDP came in a little bit stronger than anticipated, but all in all, the global economy it looks like it's slowing. Let's look at figure 6 here. More commodity news. Yeah, I think this is just an interesting chart to show that when the PPI comes out, everybody looks at the finished goods. There's also crude goods, excluding food and energy. Look at its correlation with the CRB raw industrial. So the underlying cost pressures in the commodity area remain extremely strong. Now let's look at the PPI consumer personal consumption. And you can see that's up 10.1%. The CPI came in at 8.5%. And the PCED is still a February number. I guess I should put March and February, remind me to do that. Some of my colleagues are on the call, so they'll remind me. I think Melissa's on. PCED inflation is 6.4. So there's no peak here, especially given what we're seeing in March, PPI and CPI. And there is a component for personal consumption in the PPI finished goods. Look at the PPI final demand for services. And this is another rather startling and disturbing chart. Trade services, it turns out, is markups by retailers and wholesalers. So I guess that's the way the PPI folks look at inflationary pressures at that level, at the producer price level. They look at markups, and markups are up 17.1%. How is that possible that retailers and wholesalers are raising prices like that? Well, part of the story has got to be that nobody's discounting anymore. You don't have to discount. And everybody figures that everybody knows that prices are going up and they're not resisting the price increases. So it is what it is. It's 17.1% on a year-over-year basis for these markups. And then another disturbing one, which is no surprise, is transportation and warehousing services are up 21%. So again, no signs of a peak. On the other hand, whatever else is there, in other words, services excluding the trade and transportation and warehousing, these two, you can see that's somewhat more moderate. But clearly, these are rather important components of the PPI. How about the New York Fed Regional Business Survey? It's the first of the 5 regional business surveys that have come out for April. No peaking there. Here's prices paid remaining in this high area. Remember, this is a diffusion index, so it just doesn't go straight up. At some point, when you ask purchasing managers and others at a company, how's your pricing going? And they'll say it's just as high as it was the month before. And that would actually bring you down to 50. So saying that it's a little bit higher or higher keeps it up very elevated, as is the prices received. So we're in a wage price rent spiral. This is, as you can see, the wage inflation using the Atlanta Fed's wage growth tracker. And over the past 3 months on a year-over-year basis, we're up 6%. So we're certainly seeing this going up straight up. And then rent inflation is also going up. And as I said, with a lag, that's going to continue to go up. And so if rents are going up, that puts pressure on employers to pay their workers more so they can continue to live in the neighborhood where they work. And as rents go up, workers demand higher wages to pay for their cost of living. So how did this all get going? Well, we all know by now that excess fiscal and monetary stimulus was a big contributor, in addition to the pandemic, in addition to supply chain disruptions, in addition to the war, the invasion of Ukraine by Russia. But here you can see in this chart the tremendous increase that we've seen in total federal outlays as a result of the pandemic. And this is an important component. That's income security. That's all those checks. It's helicopter money. They deposited money, 3 rounds of checks into millions of people's bank accounts. And the Fed accommodated that deficit with easy monetary policy. And it was helicopter money. And that was certainly a big stimulus. Now that's kind of rolling over. I guess it's something to consider that fiscal stimulus isn't going to, is more likely to be a downer than an upper as it was over here, to use some drug technology, terminology. Figure 12 shows tax receipts. For the government, inflation is a wonderful thing. It's good to be a king in inflation as long as they don't overthrow you. And which, by the way, might be the case in the midterm elections, and we'll see how the presidential elections go. But people are not happy about inflation. Not only do they have to pay more, and their wages are going up and are being eaten by inflation, but they also have to pay more in taxes. And you can see that personal income taxes have been absolutely flying here. This is personal income taxes, and that's been the big contributor to the increase in total taxes. So the federal deficit's actually been narrowing because of inflation to a large extent, and because the outlays have been coming down. So here we have federal public debt. The marketable securities is what we use to kind of see what the interest rate is that the Treasury is paying. And right now it's about 1.6% on $394.4 billion of net interest. As a percentage of that marketable debt outstanding, they're paying through March on average of 1.6%. We kind of did a Blue Angels analysis and showed that at 2, 3, 4, 5%, this is what happens to net interest. So while inflation is great for boosting the revenues of the government, it's not so great in terms of what it does to interest rates as they go up. So why don't we open it up for some questions? So far, I see one question. Be happy to take a few more. Let me just see who's got a nice group of folks with us, over 150 people. So I presume I didn't cover everything that is on your minds. First one, Bullard has cited the 1994 tightening as their working precedent. In 1994, the Fed raised rates 300 basis points and they broke. Orange County, the Mexican peso, and the Japanese financial system. What do you think is likely to break this time? It seems that the financial system is far more levered now than back then. That's a really good question. Though in 1994, we didn't have an official recession, but as you pointed out, there were some things that broke along the way and took some of the inflationary pressures off, I suppose, from that kind of perspective. I think in terms of what it could break, it's let's face it, it's always a surprise. We never know who really just leverage themselves up with low interest rates, figuring that they were going to stay low and that they wouldn't go up. So when they have to refinance, they suddenly find themselves into trouble. Or even if they don't have to refinance, if they just have to raise more money, if they have to raise it at higher costs, that hurts as well. So it's hard to say who took those kind of bets, but we are, asking for trouble in the sense that, when you look at that 2-year Treasury note, that basically since last summer has gone from close to 0 to 2.5% in such a short period of time, that could destabilize something out there. As might the big backup in the bond yield from, let's say 1.5% a year ago to almost 3% right now. So we'll see. I would say that it's less likely to be in the United States than perhaps in the emerging market area. We know that we're getting close to a Russian default situation on their debt. It's kind of pretty widely known, and probably some of the losses have already been taken by some of the financial institutions in terms of getting ready for them. But it could be some of these emerging markets that suddenly have some debt default issues, I suppose. So that's kind of, I'd look more overseas. I still think the U.S. overall is in pretty good shape. Since 2008, the banking system is in much better shape. The consumer is in much better shape. For Wednesday's morning briefing, I'm doing a piece on corporate finance, and corporations have refinanced a lot of their debt at record low interest rates. Their cash flow is all-time record high. Cash on the balance sheet is ample. Every now and then, I kind of worry that if something really blows up big time and everybody wants to get out of stocks at the same time, that the ETFs may be the source of the distress this time, to the extent that a lot of individuals just willy-nilly get out of the market, sell ETFs, then the market just kind of goes down no matter what the fundamentals are of the individual stocks. But, we've had a few of these flash crashes in ETFs without that kind of consequence. So I don't necessarily see it there. The credit markets is where you want to look for things that might blow up. I mean, in 2015, there was a lot of concerns about energy bonds because the price of oil took a dive. There's obviously no concern along those in that regard right now. And I am looking at the high yield market. I just don't see a tremendous amount of distress in any areas there at this point. The problem with that high yield indicator is by the time you see it, you're in trouble, and it may actually be almost too late to panic, or you'll be panicking along with everybody else. So, admittedly, the signals from the credit markets sometimes aren't leading ones. They're kind of coincident or lagging. Okay, we got a couple of more questions here. This is from Bing. The previous question was from Doug. Bing says, ISM order backlogs appear to be very healthy. If ISM new orders goes into contraction, how much and for how long do you think backlogs can support revenue and earnings when companies report GAAP earnings? Good question. A lot of us are looking at the backlog of orders and delivery times and looking at it not the way you are. You seem to be looking at it as a sign of cushion for the economy. A lot of us are looking at it for signs of supply chain disruptions, that the reason the backlogs are high, the reason that it takes so long to get things is because of supply chain disruptions, and that's actually disrupting economic growth. We can clearly see that in the auto industry, where there's a tremendous amount of the demand that just can't be filled, and you almost have to order cars and wait for them. So it works both ways, is what I'm saying. I wouldn't mind seeing a drop in backlog of orders and delivery times if it seems to be associated with a amelioration and improvements in the supply chain disruption, so we can kind of do things more normally. But to your point, that's a kind of interesting observation that if things do slow down on the demand side, there's enough backlogs to keep things going for a while. Okay, this is an anonymous person, so I'll read the question more carefully here. Can you comment on the potential of the Ukraine war and the move by Russia and probably China away from the dollar, and the potential of the dollar losing some of its status as the world's reserve currency? I've been thinking a lot about that. We've all, I think, been focusing on that kind of issue. Is the sanctions that were imposed on Russia were much more severe than anything that's been imposed on before, and basically confiscating their dollar reserve assets and maybe their euro assets for the central bank. I mean, that was quite a startling move. And you are definitely going to see totalitarian regimes come to the conclusion that they don't want to be in dollars, they don't want to be in euro or yen. So you would think the price of gold will be absolutely flying right now, as totalitarians around the world just kind of decided to convert some of their foreign exchange reserves into gold. But you're not really seeing that at this point. I think the dollar and the euro and the yen are going to stay important reserve currencies. I think the dollar will remain the preeminent reserve currency. I mean, we have a lot of advantages here in the U.S., and one of them is that it's a huge economy. It's a very diversified economy. It's a capitalist economy still. The rule of law still matters here. Entrepreneurial spirit reigns. You still have a tremendous amount of venture capital. And a lot of people around the world have to do business with us, whether they like us or not. And for them to do that, they're going to need dollars. So I think the key to understanding why the dollar has been strengthening and remains strong is in a world of geopolitical insecurity, uncertainty, and risk. People want to invest in the dollar, and that's that TNEC idea. You know, TINA is there is no alternative, which is why people have been buying stocks, the theory anyways. And TNEC, just adding a C, is there is no alternative country. That in a world of geopolitical turmoil, the U.S. certainly looks like a good place to park your money. As long as you're not a totalitarian and risk having it confiscated. Well, I got it this time exactly to 11:30. I covered my questions. So thank you all for joining in, and we'll see you next week. Have a good week.